So a dip that is 5% or more, or 5% and less than 10%, happens about 3 times a year. And their average length is 43 days. And a dip of 5% or more, but less than 10%, occurs 3 times a year. This time, the S&P 500 went down by 9.7%. So it fit right here. It's not even a correction, it's a dip. Between 10 and 15% is called a correction. And that is 10 to 15%. It happens once per year. Okay.
Wow.
A severe correction is 15% to 20%. So here's a severe correction. This happens once every 3 years. And a bear market is anything over 20%. And that happens once every 6 years. We just came out of a bear market and we're seeing our first dip. There are chances of 3 more of these in a year if you look at statistics, probability and statistics. So that means we'll have more opportunities to pick up stocks at Christmas sales, which I call Christmas sales because they're dips.
Yes, but this 42 days, 43 days, 110 days, and 251, I'm thinking that's a long time.
That's right. That's right. And I would say,
how should investors look at it then?
I think some of the major dips that happened in 2008, 2002, those lasted for a long time. They may be skewing the numbers, but I think recognizing that these dips happen frequently is very important. Now, how you deal with them, I'll tell you how you deal with them. So let's say the stock market is going like this, right? And suddenly a dip comes and it goes like this, it goes like this. What you got to do is called portfolio management and allocation. So if you have, let's say, 20 stocks in your portfolio, that means every stock is going to have 5% allocation. You never allocate 5% in one shot. You say, I'm going to do maybe 3 of these purchases a year. So every quarter, you can just start putting in 1/3 or 1/4 of your money that you had pre-allocated to a certain stock. Then if a dip occurs, you're just getting a larger volume. This is a very simple way of what's called dollar cost averaging. Just keep doing that, click, click. And if a dip occurs for a longer duration of time, you're just going to get a higher volume of those stocks. When you get higher volume at lower cost, your average cost per cost basis, ACB, goes down. And when the market picks up, your cheaper stocks grow and your total portfolio value grows. That's basically how you take advantage of it. You also have to be able to pick up stocks of good quality companies, because to say cheap junk is just junk. If you say, oh, this stock is really cheap, I'm going to buy it. If it's junk stock, it's just junk. You're accumulating junk. So learn to figure out which are great quality companies and their mechanism. There's a whole process to identifying that. There's math behind it.
Wait, and we're going to do it. We'll set up a time maybe 2 weeks from today so that you are ready. And then we'll do another edition. And you know what, to be truthful, I think this is so good knowledge. I know I teach and talk and everything about real estate, commercial real estate, and hotels, and multifamily, now senior assisted living, residential assisted living, all that. But people's net worth is in the stock market. $39.9 trillion
That's right.
are in the retirement funds, close to $40 trillion in retirement funds. And that's what you're talking about right there.
Right. And like if somebody goes in, they have their 401ks, IRAs, majority of the time they're going to the stock market. And most of the people have no idea how to take advantage of the stock market. They depend on fancy financial advisors in suits and ties